All right, guys, welcome to another video. I'm going to cover Snapchat today, one of my favorite growth stocks. It is down on it must be the Tesla news because Tesla was down today on their earnings and margin compression. And it looks like a lot of the growthy stocks are down. I can't find any good reason for Snapchat to be down. Maybe it's just the valuation. Maybe it's just investors are taking profits because it is a little bit on the expensive side for its current valuation, and I'm going to show you why. I'm going to use Bard, which is Google's new AI. I ask for some advice. Here, I'm just going to get it warmed up. It's a large language model. It's just like chatgpt. I'm also going to use Seeking Alpha. I have Snapchat pulled it up. And according to their expectations, we have some earnings expectations, and we're going to use that to get an idea of what we should pay for a company like Snapchat. I also have my own model right here, and I'm going to use mainly Peter Lynch philosophy. And what Peter Lynch does is he looks at the potential growth rate and he tries to estimate what it can grow over, let's say, a decade. And he uses that number and he multiplies it by 1 or 2 to get an idea of what we should pay in that year. So let's jump over to Bard and say, what is Peter Lynch peg ratio? And it's going to pull it up for us. Peg ratio, price to earnings growth ratio, a valuation metric that compares a company's stock price to the earnings growth rate. So I won't dive into that. But this key sentence right here, he believed that a peg ratio of 1 or less was a good indication that a stock was undervalued. So jumping back to the earning estimates, they are growing at 40%, 80%, and 56%. But we're not going to use the earnings growth rate. I'm more interested in the revenue growth rate because it'll give us a better picture of what is sustainable. If the growth is growing in sales, that's what we want to look at. And then I know that for the next 3 years, I have clarity on the EPS. So I punch those in 23 cents, 43 cents, 68 cents. And then I already have the peg ratios plugged in. So I'm going to use peg one, $3.05. If we see Snapchat below $3.05, the idea is that Peter Lynch would say that's a cheap price. Next year, if we saw the price at $6.05, Peter Lynch, in theory, would say, "Hey, that's a good price." And you do that for each year. These other years, I used 15% to grow it out. So that's how we get a future decade price. It can be anywhere between 31 and 62 according to my model. Now, the model changes. That doesn't mean it'll happen. It doesn't mean that I can't do better. It doesn't mean that I can't do worse. But I find it super useful to have some kind of a mental model for how good it can be. Because you're going to look at these stock price gyrations and you're not going to know what to do when you have a down day like this, when it's down almost 8%. So let me jump over. Let's do some assumptions. What should I calculate? I'm going to calculate what my return is. If it goes, if I buy at $10 and it goes to 62, what's my return? I buy at 10 and sell at 62 in 10 years. What's my compounded annualized growth return? That's pretty good. So it says it would be like getting 18%. And I think that's what I have roughly. Yeah, I show 20%, which is close enough. So let me see. Also, what is Kager? I'll do that as well. Kager is compound annual growth rate. So this is how you get. One way to think about it is if I had if I had the money in the bank instead, what would the bank have to pay me to have a comparable return to this stock scenario that I plugged in? And that's what Kager is. It's the annualized rate. Let me do, let's say Snapchat goes lower. Let's say it goes, something horrible happens. We do get a recession and I get to buy it at 5. What's my Kager if later in 10 years it's 60? 62 in 10 years. It's my Kager. 27%. So it's very fascinating to see, if you can buy it lower, obviously we know you'll make more money, but what price can it be? And then what is it? What is it? How much did you make that year? If you divide it out and spread it out over 10 years, what's the compound rate of return? So that's why I like these new models. I can do these in Excel, but you can do them really quick just by talking to it. Okay. I know Snapchat has their own model coming out, and it's more of a companion model, but you can also do the math in there. That's all I want to cover right now. I just thought I'd share this concept since we're getting more and more AI tools, and Snapchat is getting in there. So we'll have to keep an eye on them. Cheers.